Good morning, and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Alex Mathew. I hope a lot of you, or rather all of you, had a lovely midweek market holiday. And quite a few of you, having seen the way that markets behaved on Monday, would have been very happy with that break in trading. If you were to only look at the print of Monday's close and you saw the selling across the board, you'd be forgiven for wondering whether the cuts are not done, whether the selling is not done, and whether that will continue today as well. But if you zoom out and you look at the entire landscape of global markets, you will notice that the Asian markets at this juncture are sanguine. You had the US markets overnight that closed higher. The bond yields, which were a big concern, have come off in the US. You have the 5-year, or rather the 10-year bond yield that has come off from that 5% mark to 4.82%. To get a sense of all that has happened since Monday, though, and to lay the context for us, we're joined by Norman Chan, independent investment strategist, and he's joining in from Hong Kong. Norman, thanks so much for joining in, and good morning to you. A lot of headlines to focus on. What I was looking at very closely this morning was what's happening in China, because apparently Xi Jinping has visited the PBOC the first time, I believe, in a decade. There's an update in terms of higher government borrowing, more issuance of government debt, and there's also a change in the fiscal deficit number. The ratio has now changed to 3.8% from 3%, which hasn't happened very often in the last two and a half decades. What can you tell us about how that will have a bearing on global markets?
Sure. Good morning, Alex. Thank you for inviting us. And I think the China stimulus policy has been confirmed as very sizable. And also the fiscal support showed that the government is keen to underpin the economic growth. And that's why the China stock market, especially in the Hong Kong Hang Seng Index, rebounded like more than 40 points this morning. I think this is a good sign. And of course, the fiscal stimulus is sizable and in the right directions, but the only shortcomings is that it will be focused more on the fiscal side and not quite directly to the consumptions market and also the ailing property sectors. And those sectors, especially the property sectors, probably would remain weak, and because there will be a lack of direct support. But hopefully the other sectors, which has been stabilizing and bottoming out, would be able to carry the economy to achieve a 5% growth this year, as well as like 4.5 to 5% growth next year. And I think China is still avoiding to an overwhelming fiscal support. And but that's better than the economic outlook and the market outlook like just a month or maybe a few weeks ago. And I think the problem is without a more comprehensive support, there is a chance that the sustainability of the rally we have seen today may not be very long-lasting just yet. And the market will probably need to consolidate a little bit more and wait for more stimulus policies before they can completely reverse the downtrend. In the meantime, I think the market would go up gradually, but in a volatile way.
That's an interesting perspective. So unless something more broad-based is announced, according to you, we could see some consolidation going forward. And I think consolidation is the name of the game in several markets as well, our markets as well here in India. So we're trying to get a perspective on where global fund flows are heading, because on the one hand, you have China. On the other hand, you have the US, which will have key GDP data that will be out shortly. And also you've seen yields, Norman, come off since Monday to 4.8 odd percent. What happens with those elevated yields and the fact that yields are likely to stay elevated and the dollar looks relatively attractive according to several people? What happens to global fund flows?
Well, I think global fund flow is going to probably benefit India more than China for the moment. As it's quite clear that foreign fund flow has been leaving China market. And for the time being, in the near term, I don't think the foreign funds will return to China very soon. And Indian market, although it's going through some consolidations, is still more attractive to foreign funds than China within the Asian mandate. And the US dollar, I would like to say that although it looks like not very demanding, and given the rise in bond yields, I'm a little bit also worried that, okay, given the strong gain in bond yields in the past 2 or 3 weeks, the US dollar has not really make too much progress. And it appears to me that there's a possibility that the US dollar might have been peaking recently, and especially as bond yield seems like also peaking, and in the short term it might be trading around 4.8% to 5% for the 10-year US Treasury yield. But I suppose that may not be helping the US dollar too much. If US dollar start to come off a little bit, although I don't expect them to drop too much, and I think Asian currencies would become more attractive, and that would probably also help attract more fund flow to Asian market, including India.
Final question then, with respect to the Indian equity markets, how do you perceive India in the context of everything that's happened globally? We've seen a bit of a selling spat or a spate of selling rather at the start of the week. And a lot of people are talking about whether or not we've reached that fear zone and whether support can be found at this point. We saw a net buy number for foreign institutional investors on Monday as well. And I'm just wondering whether you think that the valuations relative to the other emerging markets here are looking attractive at this point.
Well, I think Indian has some major rebound previously. And I think at the moment, Indian market is probably going through some kind of consolidations. You probably know the Indian market better than me in the near term. But so far, I think the foreign sentiment on the Indian market is still positive in the long run. And it's just that after a big inflow earlier, I think the foreign investors probably would like to see more concrete sign that the Indian economy and the Indian companies' earnings are improving as they expected before they would inject more capital into Indian market. So I think in the long run, as long as the Indian economy and corporation profit would be able to deliver, which is probably the case, and the foreign inflow would resume probably early next year.
Thanks so much, Norman, for bringing us that perspective, and thanks for joining us this morning.
My pleasure. Thank you.
All right, let's get a sense of the F&O queues as well. We're heading towards monthly expiry, and Agam is joining in with some perspective. Agam, interesting cues from what we saw on Monday as well. We were discussing just a short while back that the VIX didn't come off despite the kind of selling that we saw. Or rather, VIX came off. It fell instead of rising despite the selling.
So, Alex, that's one of the most interesting things that's played out on Monday, because we did see sharp cuts of around 1.2, 1.3% on the benchmark indices. We have to remember that this is, again, in the context of we're not used to an intraday decline of around 1.3% on over the past 3 to 4 months. Because of that, in spite of that, we really did not see the India Volatility Index move up substantially. In fact, at the end of the day, it only moved 0.8%. On any other day, when you would see a benchmark fall by as much as 1.3%, well, you would usually see the India Volatility Index move up by around 3 to 4% minimum. So that's basically indicating that at least as on Monday, not a lot of traders were expecting a substantial move coming in forward. That said, does that mean that we can expect consolidation and no more correction in today's day of trade, or for that matter over the next few days? No, that's certainly not the case. Should we see more weakness coming into the markets, and should we see more selling pressure coming in? Well, it's also going to trigger a waterfall and cascade effect, and which may actually in fact lead to more weakness. In that case, we will certainly see an increase in the India Volatility Index as well. As far as Monday is concerned, well, it is a rollover week, so we are going to start seeing a lot of positions being taken over, and because of that, we are starting to see a little bit of build-up as far as the Nifty and the Bank Nifty rollovers are concerned. That said, well, tomorrow is the big expiry, the big monthly expiry, so we'll be watching out for that. Very quickly, as one may expect, a lot of the activity has shifted downwards, but this is taking into consideration only tomorrow's expiry. The picture is very different when it comes to the November, expiries, especially the weekly as well as the monthly ones. But we're watching out for, as far as the Nifty is concerned, a lot of activity around 19,500, and as far as the Bank Nifty is concerned, a lot of activities around the 43,000 400 and 300 mark. So we'll be watching out of that, Alex. Well, the story isn't finished, but that said, for now, it isn't looking as bad as well a lot of traders were making it out to be on Monday.
On the downside, based on the data that you've looked at, where does support come in initially?
Well,
for the Nifty
19,000.
50?
Psychologically, it will be 19,000 for now.
Okay, fantastic. Thanks so much, Agam, for bringing us those details. Let's focus in on earnings, because that's going to be the other big talking point. You've had several numbers that are already out and a couple of big numbers to watch out for as well. From the financial space, I would be focusing on PNB Housing, because that's an interesting set of numbers to talk about. Varsha is joining in with a whole list of companies that you should be tracking this morning. Morning, Varsha. What are you picking up?
Good morning. So, as you rightly said, PNB Housing has came up with Q2 FY24 numbers, and the total income rose almost 6% at rupees 1,767 crore. Now, the net interest income grew 1.8% year on year during the quarter under review to rupees 661 crore. On a quarterly basis, the NII rose 5.1%. Now, company's asset quality improved significantly, with GNPA falling to 1.78% of gross advances at the end of the quarter from 3.76% in the previous quarter. Similarly, net NPA ratio declined to 1.19% as against 2.59% in the quarter ended June. Now, this was due to resolution of its large corporate non-performing account of rupees 780 crore. On the retail side, it was a function of aggressive collection and one-off retail write-off. The company's AUM increased 2.2% year on year, while sequentially the AUM rose 0.1%. Then we have Mahindra Logistics, where the revenue was up almost 3%, EBITDA was down 20%. Now, there was an impact in freight forwarding business, where company's revenue was down 56% and company faced continued price correction in cross-border freight prices. Then we have Lloyd Metals and Energy, where revenue was up 61%, EBITDA was up 82%. Now, Q2 being a traditionally softer quarter for mining due to monsoon season. So if you see sequentially, the revenue fell. Also, company saw improved realization and reported better EBITDA per ton on iron ore than the previous year. EBITDA margins for ore remained flat quarter on quarter, even in the face of lower production, which is a positive outcome. Also, there was a routine shutdown in Q2 FY24, which impacted quarter on quarter production. Sponge margins remains consistent. Then we have Alok Industries. Now, we all know what textile stocks are facing problems because of low demand, excess inventory with retailers, limited supplies. And so textile companies are hoping that demand revival is around the corner. So we have Alok Industries, whose revenue was down 20% and EBITDA was at 35 crore versus EBITDA loss of 11 crore. Now, this was due to decrease in material costs. The companies are expecting a demand to pick up again by the third quarter of FY24 as global retailers slash inventory. So let's see how Q3 will play out for Alok Industries. Then we have Kewal Kiran Clothing, where revenue was up 15%, EBITDA was up almost 23%. And if you see, as on September 30, the EBO stands at 470. Then lastly, we have a pharmaceutical company, Torrent Pharmaceuticals, where revenue soared almost 16% and it reported 24% jump in the second quarter net profit. Its India revenue was up 18%, while the earnings from German operation was up 21%, which was led by new tender win coupled with better conversion of existing tenders. Also, Brazil saw a growth of 36%, aided by performance of top brands. And this offset a 15% decline in US revenues, which was impacted by low margin business and lack of new tenders.
All right. Thanks so much, Varsha, for bringing us those updates. As Neeraj was pointing out earlier today, the texture of the market as it stands right now is pointing to more opportunities if you take a bottom-up approach. So some of this data, some of this information would be useful from that perspective. But there are a couple of frontline companies that will be reporting their Q2 results, one of them from the banking pack, and the last major private sector bank to report its numbers, Axis Bank. And that's going to be what we're talking about right now. Himansh is joining in to give you some perspective on what is expected. Morning, Himansh.
Hi, morning.
What are the key numbers to watch?
So, Axis Bank, like you rightly said, the last private bank to report its numbers, and it's going to be key to watch out for. The street estimates point to a 8.8% rise in net profits to about 5,800 odd crores, and the net interest income is also expected to rise by about 16% on an annual basis to 12,000 crores. Now, loan growth and deposit growth both are expected to remain strong, as they have, deposit growth being partly helped by 2,000 rupee notes coming back into the system, and loan growth, remaining strong across segments like retail and corporate. From a margin perspective, though, margin compression has been seen amongst larger peers as well. The domestic net interest margin for the bank last quarter was at 4.2%, and it is expected to remain under pressure. Talking about loan growth and mix of advances would be key in offsetting the rising cost of funds, because retail loans tend to be higher yielding, and 58% of Axis Bank's books were composed of the retail advances. Now, of this 58% chunk towards retail, 25%, which is the highest seen in past 5 quarters, comes from the unsecured portion. Now, from the RBI governor down to analyst and the street as well, everyone expects this portion to create some problems down the line. However, it's a wait and watch as to how it plays out. CASA ratios have declined across several banks. It stood at 43% for Axis Bank last quarter. And while operating expenses are expected to remain elevated, especially because after the Citigroup's merger into Axis Bank, their operational expenses, as they merge and consummate the entire process, operating expenses are expected to remain elevated, and then this is going to reflect in the cost to income ratios as well. Commentary to watch out for would be across the premium segment from the Citi portfolio, growth across cards, margin sustainability, and outlook ahead. So that's a wrap on Axis Bank, and let's see what the earnings reflect in today and tomorrow.
Certainly. Thanks so much for bringing us those details, Himansh. As Himansh pointed out, that unsecured book is certainly something to watch out for, and provisioning number, therefore, and slippages in the quarter gone by are numbers to watch out for. The other frontline company comes from the IT pack, and we're talking about Tech Mahindra, and we're joined by Tushar to get some perspective as to what to watch out for. Tushar, it's broadly been a disappointment so far by the frontline IT majors. What's expected from Tech Mahindra?
More of the usual, Alex. What you just said, it's going to be like that. If it's not as bad as Wipro, at least maybe a little bit better than Wipro. But aside from the numbers, you just have to look at a few pointers for the company. We know that the numbers are going to be under pressure, but let's not get into it. Let's talk about what is going to happen. So revenue is going to slip for a second straight quarter. And the operational profitability, which was about 12% a year ago, they were down to 8 to 9% a quarter ago. They can slip even further. Now, what you should watch out for? You should watch out for the commentary by the management on when the margin recovery will finally come in. Now, the margin recovery will only happen when the deals that they are winning. See, example, they're still winning the deals. So what you have to watch out for is when the deals will start converting into revenue. They also have to look at how the growth in their most biggest vertical, that is the CME vertical, when will growth return in that vertical as well. We also have to consider that it's about just a couple of months. We are just a couple of months away from a new CEO, Mr. Mohit Joshi, taking the helm at Tech Mahindra. So what will be his strategy going into a very crucial year in 2024? So overall, the headcount is also likely to decline. Again, that should support margin, but how much, only time will tell. Alex.
Certainly. Thank you so much, Tushar, for bringing us those updates. Tech Mahindra in focus as well. Let's quickly take you through some of the other stocks that are likely to see action on the back of updates that have been sent to the stock exchanges. And Rishi is joining in with a list of stocks. Morning, Rishi. What are you picking up?
Good morning. So firstly, there's Lupin, which has received the US FDA's approval for a new drug application of the fluconazole tablets. Now, this is specifically with respect to approval for marketing a generic equivalent of diflucan tablets that is made by Pfizer. Now, fluconazole tablets generally have an estimated annual sales of over $43 million, and Lupin is looking to tap into this market. Then there's Delta Corp, where the Bombay High Court has directed the Directorate General of GST Intelligence to not pass any orders with regards to 16,000 crore alleged tax shortfall that the company and its subsidiaries had received a while ago. So this is a relief for the company and for the stock price as well, because lately it has been receiving a lot of GST tax fall notices. Then there's KPI Green Energy, which has received an order for 4.2 megawatt wind solar hybrid power project, which includes a 4.2 megawatt wind capacity and a 3.6 megawatt solar capacity, and it is expected to be completed in this fiscal. So with this order, its cumulative orders also crossed the 196 megawatt mark with respect to wind solar hybrid power projects. Then there's Power MedTech, which has approved a 350 crore QIP. The company will allot about 9 lakh shares at a price of 3,881.17, which is at a 0.5% premium to yesterday's closing price, day before's closing price. Then there's Signature Global, which will acquire a 25.75 acre land in Gurgaon, and this acquisition is to develop a group housing project, and the overall potential developable area is approximately 3.25 million square feet. Then there's rice stocks, which will be in focus because the union government is likely to cut the floor price for basmati rice from $1,200 per ton that was set earlier to $950. It will be important to watch out for stocks like Chamanlal Setia Exports, KRBL, and Kohinoor Foods because they had reacted negatively when the price was set at much higher levels of $1,200. So these are the stocks.
Export.
Minimum export price for basmati rice.
Understood.
So these are the stocks to watch
Thank you so much, Rishi, for bringing us those updates. One last point to watch out for today, and that is action from the primary markets. We've got an IPO to talk about. Blue Jet is the name of the company, and Mihika is joining in with all of the details. Morning, Mihika. What are you picking up?
Good morning, Alex. So, Jet Healthcare's IPO will go live today and will stay live till October 27. The company plans to raise 840.3 crores via an offer for sale, which consists of 2.42 crore shares, and the price band fixed is between 329 to 346 rupees. The company has also raised investment from anchor investors to the tune of 252 crores. It allotted 72.9 lakh shares at a price of 346 rupees. The company will not receive any IPO proceeds, as all the proceeds will be going to the selling shareholders. A little bit about the business. It was founded in 1968 and it's a specialty pharmaceutical healthcare ingredients and intermediates company. It was first a manufacturer of saccharin and its salts, which are artificial sweeteners in India, and later expanded into contrast media intermediates, which are used in CT scans and MRIs. The operations are mainly based in 3 product categories. One is the contrast media intermediates, second is the high intensity sweeteners, and third is pharma intermediates and active pharmaceutical ingredients. Coming to the financials, over the period of FY21 to FY23, the company has witnessed a 45% revenue growth and a 6% EBITDA growth. However, EBITDA margins have been down 11%. With respect to net profits, the profits are up 18% from FY21 to FY23. However, the net margins have been down by 5% over the period.
All right. Thanks so much, Mihika, for bringing us those updates. And that brings us to the end of this edition of Trade Talk. As we start the trade for the day, you're probably wondering what you should do with your strategy. And we've got conversations lined up through the day to get you just that perspective, starting with one at 9 o'clock. So do stay tuned.